Ah, yes, the SQN indicator. This is one of my favorite tools. It's a lagging indicator that I use to identify market regimes. And today we're going to be talking about the SQN, how it works, what market regimes are, and how I use the SQN with it. But first, I need you to hit that like button. It costs you nothing, but it really helps me out. And while you're at it, you should subscribe to the channel. We're putting together a couple of videos per week. Our main video is the weekly market overview that we put out towards the end of the week. Not so much to tell you what happened this previous week, unless it was significant, but more the process of I'm looking at, what we're looking at MacroOps for the upcoming week. Use it as your process to think about how you're going to set up next week, your plan for the next week. It's built to look ahead. And with that, you'll see our process at work. And some of the other videos that we're putting out are ones like today, where we break down key parts of our process. And like I said, today we're talking about the SQN indicator, how we use it to identify market regimes. The SQN, it's a lagging indicator, and this kind of rubs people raw. It doesn't attempt to forecast what should happen next. Rather, it tells us what's already happened. Now, you might think that that's not very useful to explain what's already happened, but I'm going to explain to you how we use that to give us an idea of what environment we're in. The SQN measures the direction and volatility of the current market environment. It's kind of like knowing the season that you're in, like the summer, winter, etc. If I say it's January in Montana here in the US, or maybe Switzerland, you can get a pretty good idea of what that current environment, like what the weather is going to be like. It's like cold, icy, snowy, not many hours of daylight, and you're going to know exactly what sort of clothing you're going to need for that. You're going to need a winter coat, you're going to need hat, gloves, boots, sweaters, and also you're not even going to have to worry about a lot of other things like maybe flip-flops, swimming suit, tank top. So now you've completely removed the unlimited things that you would otherwise consider if you're about to go on a trip, and only need to focus on the things that you're going to use that are going to be necessary when you get there. And this is what the market regime is useful for. In each individual market regime, you really only need to focus on a few things, and you can just wipe out of your mind the thousands of other things that you would otherwise think you want to focus on. Now, I track 5 different market regimes. Sometimes they're called market states. There's only one market regime that you need to be aware of that precedes a major market correction. So that means in the absence of that market regime, you don't have to always worry about the market correcting. And so you can go about your trading following the plan, doing what you need to do without worrying about a major catastrophe coming out of nowhere. Now, imagine how many times you might have been in a trade that was heading your direction, trending higher and higher and higher, and you thought to yourself, you know what? This thing's overbought. I need to get out. And if you never got into that market regime where a reason to get out would have arrived, you could have spent months watching the market move 10, 20, 30% higher before you should have even started to worry or consider a market correction. So you miss out on the beefiest part of the trend because somehow you convinced yourself that the market looked toppy. So like I said, we use the SQN to categorize the market into different market regimes so that we can compare the current environment against previous environments of the same market regime. I organize that into 5 different market regimes, and they get organized directionally: bullish, bearish, neutral, high volatility, low volatility. And what that ends up being is bull volatile, bull quiet, neutral, bear quiet, bear volatile. These are just the names I gave it. Each market regime has unique characteristics, and I'll cover the nuance of each regime in a separate video because each regime has a lot going on. That being said, I will cover portions of each regime here in this video. So let's get into it. The SQN is this indicator down here, and I'll provide a link in the notes for you to go and get that free from Tradingview. But what it shows is these different color environments. We have red, we have yellow, we have green, we have blue, and occasionally in here, sometimes we can see this like very dark crimson color. Okay, it's very small. So let's take a look here what we got. We've got bull volatile, which is the blue one. We have green, which is bull quiet. We have the neutral, which is yellow. We have bear quiet, which is red. See over there. And then the bear volatile crimson, and we'll go find one of those, but it'll take a few minutes. Let me talk about the bull volatile regime first. The bull volatile regime, that's the blue one, is more fragile price action. We have larger percent changes day over day, meaning yesterday might have been up 1%, today down 1% or 2%. Big day-to-day moves. This regime is actually the requirement for a market correction. Without this regime showing up on your chart, you don't have to worry about a market correction happening. Position sizing should be reduced quite a bit. You're in a high volatile market. What took you, maybe 10 contracts to make money on in an earlier low volatility regime, maybe only takes you 1 or 2 contracts to make the same dollar amount on. Profit taking is encouraged here. Trimming your positions down is useful. And, I personally like to use the swing beast momentum system in here because what we're talking about in the bull volatile regime is a high momentum environment. We can see currently that we had in the end of December, we did get that bull volatile print right here. We got one back in March into the summer. This is 2024. But right here, we can see the S&P 500 has come off 10% after we printed that bull volatile market regime. Back in August of 2024, July is when we printed the bull volatile and we had another 10% correction. Similar sort of thing back in March. You can see that this is very common. Until we get that happening, though, you stay in the bull quiet market regime, which is the next one, the green one. So the bull quiet regime is a nice steady trend. These typically go further and last longer than most traders expect. This is when you want to buy dips or buy breakouts. You want to add to your positions here. This is more of a trending environment. So the volatility is low and bad news positively affects the market. Good news positively affects the market. It may go down, but it resolves itself higher rather quickly. This bull quiet regime is pretty common when traders who've been in the game for a while start to call market tops. And now that until you see that bull volatile print in blue, this fuels that wall of worry. People get scared as this market trends higher and higher, and they get worried that, this is a blow off top, when you haven't even got to the signal that would cause the blow off top. Again, I like to use a good trending system here, like the swing beast system. I'll even get the crypto momentum system here because it does really good job of trending. I want to be in like those nice moving average crossover type trades, breakouts that retest and go, things like that. Up next, we have the neutral regime, and the neutral is the yellow chart. So right away, we can see that there's a lot of green and a lot of blue and a lot of yellow on the S&P 500, not so much on the red. So this is why it's important. We pay attention to these three regimes. The neutral market regime is oftentimes a transition period, okay? A lot of mean reversion type trading happens here. This is the curvy system that I use. It works great in this environment. You can sit in it and write it out, buy dips, sell rips, get that reversion happening. So a lot of people get caught up in the idea of trying to catch a early breakout. A lot of those breakouts fail in these types of regimes. Up next, we have the bear quiet regime. Now, since we're talking about the S&P 500 in this video, this regime actually very rarely happens. Only about 10% of the S&P's, like 70, 80 years of history on the S&P 500, only about 10% of the time has it been traded in this bear quiet regime. It's rare. When it does happen, it's an excellent environment to day trade. It's not very good to be holding positions overnight. Again, I like to use my curvy day trading system here because it goes both directions. And in the bear quiet regime, you tend to get big reversals in both directions. Maybe a news event hits, it'll send the market rocking. Another news event, it'll send it down. And these moves tend to move pretty big. And they happen in a period of consolidation. This is why the curvy system works really well for this environment. And now we have the rarest of them all, the bear volatile market regime. This thing is so rare that you can almost avoid it altogether because it counts for less than 1% of the S&P 500's entire life. But if you're going to be psycho, if you're going to trade it, and I know you will, this is one of those things where you want to use very small position sizing because we can have 5, 10, 15% moves in a single day on these indices like happened back in March of 2020. You want to get in and you want to get out. You want to get in where it's possible. You want to get out. You don't want to hold overnight. If you do, you want to use maybe options or something like that have very limited downside with a big upside. Another characteristic of the bear volatile market regime is, yes, this is major market bottoms happen here. And those are very rare and they happen really quickly, mostly because governments are very quick to step in and support a market that is in this bear volatile regime. This is a crash. Bear volatile represents a market crash. Okay. So governments are moving heaven and earth to support the markets here. So like I said, I'm going to go ahead and put the link to the SQN indicator. Let me show you right here. It's the SQN Christie Fallible. Currently, it's by Christie Macro. There's 437 likes of it. That's the one. It's free. Grab that one. It's free in TradingView. I'm going to put the link down in the description of this video. I'm also going to put a link to the Curvy trading system and the Swing Beast trading system for you to check out. Now, the key point to all this is using the appropriate market regime matched with the appropriate strategy and asset so that you're not trying to trade a trending system in a mean reverting environment or a mean reverting system in a nice trending environment. You want to match the appropriate system to the appropriate environment. Now, you just got to know nothing works in every environment, in every market regime. So you're going to want to have an arsenal of a couple of different strategies. You could stick to just one and just move around to all the different assets that are in that market regime that it works great on. That's one way to go about it. Or you can adapt with each one. Now, I go into a lot further detail in my weekly newsletters. I send out a couple of newsletters every week. You can subscribe at macro-ops.com. And if you want to interact with me on X, I'm at Chris D Macro. There's my thing in the chart right there. Follow me, ask me questions, say, hey, what market regime are we in? What strategy should we be looking at? All those sort of stuff. I'm happy to help there. Do some comments down below. Like and subscribe. I love you all. Bye.